So in this video, we are starting off with chapter number 25. The name of the chapter is Analyzing Performance. And the very first thing that we learn, so basically this chapter is all about the ratios. What are the different types of ratios which you can calculate to analyze the performance of any company? So the very first that we learn are going to be the profitability measures. Under profitability measures, you have three ratios as you can see on your screen: return on capital employed, return on sales, and the gross margin. Along with that, you'll also be seeing the formulae which are used to calculate. Now, I'm also going to explain you the formulae and what the ratios actually stand for. So the very first ratio that you see is the return on capital employed. So return on capital employed basically means that if you have invested $1 in the business, how much money have you been, how much profit have you been able to make because of investing that dollar one. So it tells you how much return you have generated on the capital, on the money, on the assets that you are using in your day-to-day business. So if you see the formula, you take your operating profit, which is your PBIT, profit before interest and tax, and you divide that by your capital employed. So, capital employed is basically all of the assets that are there with the business. So, you can see it can also be represented as net assets, or you can take all of the value of the equity plus the non current liabilities. That's also your capital employed. Now, talking about is how do you assess this figure? Should it be a greater percentage? Should it be a lower percentage? Now, because we're talking about return, every business is operating with the sole objective of making profit. So, this represents your profits. Hence, the bigger the figure, the better it will be. So this figure is should be higher. So if it gives you a high ROCE value, it means that for investing every $1, you're able to generate more and more money out of your business. So this is what the return on capital employed ratio represents. Be sure that you understand these ratios well, because these are going to get continued in your PM, FM, FR, AA. So in all of the exams, these ratios carry forward with you. Then the next one is return on sales. Here you take your operating profit, which is again your PBIT, profit before interest and taxes, and you divide that by the revenue. So here you're just getting to know that how much money are you generating, how much profit are you making as a percentage of your sales. So again, because this represents your return, the higher this figure, the better it is for the business. So the higher the return on sales value, better, because low value would mean that your selling prices are too low or that your costs are too high. So this ratio can also be known as the profit margin. So return on sales, profit margin, same thing. Moving to the next ratio, gross margin. Here you take the gross profit and calculate as a percentage of revenue. So here you are comparing how much gross profit you are making as a percentage of the sales revenue. Again, higher the gross margin value, the better it is for the business. This means that the prices and the costs are at the correct level, because if the gross profit is too low, maybe your costs are too high, or maybe your selling price is too less. So this is how this helps you to find out if the expenses are in your control or not. Now, these are the three ratios which fall under the profitability measures. Now, on the study hub, we have activity 1, which is going to help us understand how exactly do we calculate these ratios. So the requirement over here is to find out the three ratios which we have just learned. So the very first one is about the return on capital employed. So let's also have our Excel sheet open side by side. All right, so here we can see all of the figures. Now, the very first ratio which they want us to calculate is the return on capital employed. Formula is right over here in front of us. We want the operating profit as a part of our numerator. So we take the net profit over here, because this is the profit which we can see without any interest and taxes. Every expenses have been subtracted, but no interest and no tax has been subtracted. So 30,600 is my numerator. Now I have to divide this by the capital employed. Now how do you find out the capital employed? Let's read further. you see you are given with the net assets. So one of the formula, it has net assets. So you can simply take this figure 323150, and this has to be always put as a percentage. So you can say that this is roughly 9.5%. Ensure that you write your answer always in a percentage format. Now coming to the second requirement, which is with respect to the return on sales. So the formula is operating profit divided by revenue. Operating profit we already know is 30,600 divided by the revenue which is given to us as 168,000. Right over here you have this 168,000 and multiply this by 100 again. So you get 18.21%. So you can write over here this is 18.2%. Alright, now moving to the last one, which you have to calculate as the gross margin. So here the numerator is gross profit, so 67,200 divided by the revenue again is 168, and then you always put it as a percentage. I forgot the equal to sign, pardon me. So this over here is a whole 40%. So this is your final answer. Let's also check whether we've done it correctly or not. Yeah, 9.5, 18.2, and 40%. So I hope that with this you were able to understand the profitability measures. In the next video that you will see, we will be talking about the further ratios. We'll talk about activity measures. We'll talk about how there's a relationship between ROCE, return on sales, and the asset turnover. We'll also talk about liquidity and gearing measures, and also last but not the least, the resource utilization measures.